Welcome to San Joaquin Spotlight, a public affairs program featuring conversations about life in the central San Joaquin Valley. This program is brought to you in partnership between KFSR 90.7 FM and CMAC Fresno. I'm your host, Sevag Tateosian. Today we're welcoming John Shore to the program. John is with the Community Housing Council, and you help families all over the valley.
We do. We help them buy homes, we help them preserve home ownership, and we help them get their credit in a place it needs to be to buy a home.
I should say welcome back. You and I have talked multiple times over the years.
Yes.
Over the 10-year San Joaquin Spotlight program lifespan. But the reason why I always like to invite you back is, you know, this market keeps changing, and you're on the ground, so you know exactly.
In the trenches.
But before we dig in, how are things going over at the Housing Council?
Pretty good. I'm pretty happy with the success that we've had. I'm starting my 6th year now as executive director. We've come a long way in 6 years. We're getting the attention of more agencies who fund agencies like ours because we've done a good job, and I'm real proud of my staff. We moved our offices about a year ago, and actually about 2 years ago now, and have a much nicer facility, and things are good.
And there was a time when, you know, I used to be at United Way, and there was ClearPoint Credit Counseling, there was the Housing Authority. I mean, there was a time where all these organizations were doing housing counseling,
Right.
because the need was there.
The need was huge.
Families
yes.
were losing homes, it seemed like left and right.
That's right.
Are we still in that situation?
You know, it's, unfortunately, we do have quite a few people still here in the Central Valley who are struggling with that house payment. It's nothing like it was 4 or 5 years ago, but it's still a big enough demand that we keep 2 full-time counselors doing nothing but home ownership preservation. And, you know, we were talking a little bit before the show about the term equilibrium and how in economics that's a very key point. We are at that equilibrium point in the housing counseling business where we have as many people coming through the door trying to save their homes as we do people coming through the door trying to buy their first home. So it's kind of interesting, and we're one of the few areas of the country that still has the foreclosure demand for help and the first-time homebuyer demand.
Are there times, you know, we all know families that have lost their home in foreclosure. We all know families that bought at the peak
Yep.
and, you know, couldn't afford it when the market adjusted. There are times where people just need to walk away. Is that correct? I mean, because there's a mentality out there where if you walk away from your home, you feel like you've lost, and you feel like this was a battle that you've come out wounded and you've lost, and there was a time when people were not. They were fighting it as much as they could.
Well, you know, I'm going to disagree with you a little bit on the walk-away aspect of it, because what happens when you make a contract with a lender to make a payment, nothing in that paperwork says that the house is going to retain its value. And I like to talk about how, well, you know, I bought a new car a number of years ago, and the second day I owned it, it was worth less than I owed on it. And I didn't drive it to the roadside and leave it there. You know, it's all about needing that car, and we certainly need a home and a place to live. So the value of a person's home is really almost academic. It's important, obviously, when you buy the house, what the value is, because your loan will be based upon what the lender agrees with you as far as what the value is. And when you sell your home, obviously the value is important. But the period of time in between purchasing and selling that home, the value is almost a moot point. Now, unfortunately, it became the center of attention when the market dropped, because people said, geez, I bought this house at $250 and now I'm being told it's worth less than $150. Let's walk away from it. Well, walking away from it just meant that more people were going to now take a loss on their investment. And I really hesitate to use that word investment, because if somebody's buying a home for their primary resident, it really shouldn't be looked at as an investment. Now, I'll tell you, I live in a home, the same home for 35 years. It was a hell of an investment, but it's because I've been in that home for 35 years. And I think that's what you have to look at, is what really are you buying? Yeah, you're buying a place to raise your family, to have many memories from, And to buy it and strictly look at the value of that property, I think is a mistake.
And so something happened recently that I wanted your opinion on or your expertise on. When the interest rate, the Fed well, let me backtrack. The Fed for years has been saying interest rate adjustment, watch out, things are going to get more expensive.
Right.
So it finally comes, and I know for 3 years at least, we've been hearing that the adjustment is going to come.
Right.
So it finally got adjusted. What does that exactly mean? I mean, I don't see the economy crashing because of it.
And it won't. You know, the Fed is smart enough, at times I wonder about that, but they're smart enough to know that you don't go from basically a 0% interest rate and jump it up to 4 or 5%. That could have drastic repercussions. So what they do is they program in 1/4%, maybe 3/8%. The biggest increase I think I've ever remember seen, or biggest decrease as far as that goes, is probably 0.5 percentage point. So I did a little math in preparation for the show today, and I figured out that for the average price home here in Fresno, if a person is qualified to buy that house, let's say at 4%, which is kind of where the 30-year fixed rates are right now, and all of a sudden that interest rate goes up to 4.25, just 1/4% interest increase, which is what the Feds did to the interest rate. What ends up happening is your house payment goes up about $22 a month.
$22 a month.
$22 a month for that 1/4% increase. So that's not a deal breaker. That's not anything to send people into panic. But it does mean that you're going to qualify for a little bit less of a house. And I also did the math on that just out of curiosity. And that means, that equates, a 1/4% interest rate hike means that you now qualify for $5,000 less home. And again, it's not a deal breaker, but if somebody is not locked into an interest rate and they've already made an offer on a house, they put them on the edge of not being approved versus being approved. So
unless they can come up with this $5,000 from.
Yeah, but most first-time home buyers don't have that. So, you know, that's almost not even an option.
So you mentioned first-time home buyer, and I know that your organization educates first-time home buyers. And, you know, when we were in 09, 10, 11, it seemed like properties were very cheap. I mean, properties were going for prices that were unbelievable almost. Well,
yes,
you've
unbelievable.
You've been in the Valley and in this industry much longer than me, so I'll take your input on that. Properties were cheap for a time.
Yeah, they were. They were very cheap, and you know, we had a lot of investors come in and buy those cheap properties, fix them up, turn around and do what's called a flip, which everybody knows that term now. And interesting enough, I saw I believe it was today on the internet, that Fresno is like one of the top markets still in the nation for investors to buy properties, fix them up, and flip them. So, you know, when we talk about a healthy real estate environment, you kind of wonder, well, who's it healthy for? Is it healthy for the first-time home buyer? Is it healthy for the seller? Is it healthy for the lender? Who's it healthy for? And quite frankly, it's healthy for all those people right now because it's a true marketplace. It's one of the best examples in economics of a true marketplace because you have all those factors. You've got buyers, you've got sellers, you've got lenders, you've got escrow companies, and they all have to work harmoniously to have a good, healthy market.
I hear from people a lot regarding this because I'm very interested in the housing market and watch whether people are going to buy or not. And you know, there was some articles that came out. Southern California investor, unnamed, has bought $11 million worth of apartments last week. And prior to that, whether it's the same person or not, they bought a couple million more so investors are still coming in the area even though prices have gone up. Now go ahead.
Well, I was just going to say, they haven't gone up that much, and that's why they're still coming in. And they're mostly buying multifamily products. There's a few of them out there still buying single-family homes, but we're always going to have the investors look at Fresno because it's always been a very affordable marketplace.
And people, home buyers, first-time home buyers, or even investors that maybe are not your big-scale investors, but the ones that have one or two properties, I hear all the time, we're too late to the dance. Oh, I wish I would have bought. And I'm sure you've heard this too.
Oh yeah.
I wish I would have bought.
The ship has sailed.
I wish I would have bought. I wish I would have bought. We shouldn't have waited this long. But you tell us, is it a good time still for those people who maybe are first-time home buyers or maybe have a property and have a little income to buy another one?
Absolutely. Let me tell you why I believe so strongly in this. If you look at a real estate appraisal on any given house in Fresno, you're going to have a value that's called market value. And let's just take the kind of the average sales price. I believe that number may be around 175 to 200,000. But let's just go with the 175 number. So the market value is dependent upon what other houses have sold for, like this house. And the appraiser has to verify that what the buyer is willing to pay for that house is accurate. But the other number on the appraisal that lenders look at and insurance companies look at is what is the replacement value of this house? If this house burnt to the ground and we had to come in and replace this house, what's it going to cost to buy the lumber, all the nails, all the everything that goes into it? And that number is considerably still higher than what you're buying that home for. So you might buy a home for 175, and you look at that page on the appraisal that says what's the replacement value, and it could be as high as 225 maybe. So because of that, you know that home builders cannot continue to build homes and lose money and not make the profit margins that they're used to. So because of that, yeah, home prices are going to continue to go up in value. I hope they don't go up real fast, and we don't have the loan products out there like we did in the early part of the century to encourage people just going nuts and making offers because we had all these bad loans, toxic loans out there that allow just about anybody to buy a house.
So lenders, are they still modifying? I know that when we were working together in this industry with other nonprofits, lenders were modifying, and sometimes you would get the principal reduction, sometimes you would get the 40-year instead of the 30-year. Are you still seeing that? Has anything changed? Yeah,
a lot of things have changed. First of all, when I started at the Community Housing Council in 2010, I would say only about 10 to 15% of the clients that came to us for some sort of loss mitigation counseling ended up getting a modification. Now, that doesn't mean that the rest of the people lost their homes. There's other options like selling the house on a short sale, walking away with some dignity. But only 10 to 15% of the people, that's not a very good average. And certainly the Making Home Affordable program, which sometimes was called the Obama plan, didn't have the teeth in it that it needed to initially. Well, over the years, those programs have been tweaked a little bit. Lenders have realized that the more they help people, the better it is for property values. That's why I'm so adamant about people walking away from homes, because yeah, it gets them out of that particular situation, but there's some ramifications, like how about the neighborhood? What are you doing to the neighborhood? And then there's another term that, if we remember to come back to this, talk about the zombie foreclosures, the little Halloween ad to the mix here. But what ends up happening is now I got lost my train of thought here. I'm sorry.
Well, let's talk about the zombie. Let's talk about these zombie foreclosures.
As I brought up something anyway, yeah. So in walking away from a house, many people thought, well, I'm going to walk away from this house because the lenders told me they're going to foreclose, and I'm just not going to deal with any of that, so I'm just going to walk away from the house. And then they, 3 or 4 years later, figure, okay, well, the lender took the house, my credit's probably improved now. They try to go back in and buy, and they found out the lender never foreclosed on that house, and lo and behold, they still own that house. And what a rude awakening to find out that—
Surprise, you still own this house.
Yeah, and it's not just a rare occurrence. That's happened across the nation many, many times. Lenders, because of the way they threaten people that we're going to foreclose on this house, they scare people, and I understand the whole philosophy. But one of the benefits in coming to a housing counseling agency is we can tell you that lender's going to try to scare you. The lender, when you're behind on your payments, is really a bill collector. They're not the customer service agent they want you to believe that they are. And now that we've explained zombie foreclosures, let me go back and finish answering the question, because now it came back to me. The good news, Sevag, is that I would say probably 50 to 55% of the people that come through our doors now are not only getting modifications, but getting much better modifications than were available years ago. And in some cases, these people got modifications 3 or 4 years ago, and because of job loss and other problems, maybe divorce, maybe illness, they've gotten into a position where they cannot keep up with the payments. They come back to us for a second modification, And I just looked at a case today where the people got a principal reduction to their mortgage of over $90,000.
Incredible.
Yeah, I mean, that's like a gift. I mean, truly, it's a gift. Now, there's some strings attached. They've got to make their payments on time for the next 3 years, and if they don't stay in the house for at least 5 years, they have to pay some of that back, but otherwise it's forgiven. And between the Making Home Affordable program that the federal government put out and the California program, Keep Your Home California, we're seeing some great loan modifications right now.
Are you still seeing, when we were doing this years ago, we would see someone who couldn't still make their payment, but they saw a neighbor get a modification, and a neighbor got a principal reduction, and they said, wait a minute, I'm going to try this too. And are you still seeing?
A little bit, but it's not as much. You know, I think people have realized that just because your neighbor got something doesn't mean you're going to get it. There's so many factors. It goes into, and I know one of the things you want to talk about is what's it take to get a loan modification?
Exactly.
So let's segue into that, because this is where somebody may say, well, my neighbor got a loan modification, we live in the same house, and we live in a tract, my loan amount's the same as his. But some of the factors are, well, who's your lender? Some lenders are more apt to give loan modifications. And who does the lender represent? Is the loan owned by Freddie Mac or Fannie Mae? Is it owned by another investor that doesn't allow for certain types of modifications to be put in place? But probably most importantly is, what's your income? Because just like you having to qualify for a mortgage to purchase a house, you got to qualify for a mortgage to get a modification. And lenders look at this ratio as being 31%. So if you quickly figure out what your gross monthly income is, multiply that times 31%, and that means your total housing expense, your principal, interest, taxes, and insurance, if your payment is over 31%, you're actually a good candidate for a modification. If it's under 31%, you know, I'm not going to say you shouldn't try, but the chances are very slim.
How tedious is the process? Because I know that from when we were doing it, tons of paperwork, sometimes read the same paperwork over again, sometimes because of time lapse, you have to submit some new paperwork.
Yeah, there's been some good improvements. One of the things that we have, that we use as a tool, it's a web portal called Hope Loan Portal. And what this does is when lenders say, again, the process is we're helping a family do the paperwork to apply for a loan modification. And as we help with the paperwork, we send it in through this web portal called Hope Loan Port. And when we send it in, we can see that it's been received by this website. It's kind of like a Facebook, only it's closed up, right? So if the lender then calls and says, well, we didn't get that form, or we didn't get the bank statement, we can say, no, go on the Hope Loan Portal, you'll see it sitting there. It's right there, we sent it, it's there. So all of that game playing, as I'll call it, where lenders would say, well, we didn't get page 4 of the bank statement, or we didn't get this form, or the form wasn't dated. They can't play that game anymore, and that was a game. I'm going to tell a story that I won't mention any names, but I was shocked when I heard this, that there was a major lender in Southern California who one of the housing counseling agencies was very, very frustrated with, because every time they sent papers over, half of them never made it. And yet the people would be looking at a confirmation that all the pages went through. So what happened to those papers? So the lady who runs this agency happens to be an attorney. So she went to the courts and got whatever type of document she would need to be able to walk right into this lender servicing office and start asking questions. So she did that. And of course, some of the folks in there were reluctant to talk to her, but some of them talked very freely to her. And when she said, how do these papers disappear? How do they just vanish? One of the, probably an ex-employee at this point, says to her, well, you see that fax machine over there? We have named that fax machine the shredder.
Oh.
Yeah, and she says, well, why would you call it the shredder? And the answer was, well, because when we have too many faxes on there, we just take them off and shred them. Now, Sevag, can you believe that story? I mean, it's like, in my weirdest dreams, I couldn't make that story up. And if somebody wants to know the facts and figures on what lender that was and who did that, I can provide all that. The point is that there were some very bad actors in this whole scenario when all of this started to happen.
Well, and not all of them were bad, but in this case,
I would say most of them were bad. I'm not going to give them too much credit. You know, Sevag, with my 30 years in the real estate lending industry, I had the utmost respect for banks. And I have to tell you something. I've dealt with them too closely now, and I don't want to bite, you know, what's the term? I don't want to bite the hand that feeds me, because we do get some very nice grants from nice banks who are realizing that we help them when we work together. But, you know, when the 49 attorney generals sued the 5 big banks and got the second largest class action suit against them, and then Kamala Harris did the same thing here in California. There was a reason all those things took place, and it was because we had a lot of bad actors in and the banks even admit it. And what's sad is they are still practicing some of those things. It just, yeah, it is unbelievable.
people will say, some people will say, why even do modifications? Why even go through there? Let the market dictate, and if people can't afford homes, let it go.
Yeah.
Your response?
Well, you know, it's interesting because as a real estate investor myself, I actually owned some mortgages. I was actually the investor. And I had people coming to me saying, I need a modification. And my thought was, well, why should I give you a modification? I loaned you X number of dollars to buy this house, and now you want me to just do away with some of that money to give you a lower payment? So I really had to do some soul searching as to whether or not it would be in my benefit to do that or not. And here's the bottom line. If I didn't work with them, what would happen? They quit making payments and I get the house back, and the house hasn't still gone up in value, so my investment is lost either way. So, you know, in my thinking, I would rather work with somebody and keep them in the house, because most lenders really didn't make loans. In fact, I'm going to go out in a branch. All lenders don't make loans so that they can take a house back. You know, if a big bank wants to buy a house, they're going to go out and buy it. They don't need you to buy the house and then we take it away from you. They're just going to let you go out and make those payments. That's what they're looking for. So it's better for the economy, it's better for the community, it's better for property values if the lenders work with you and keep you in that home. I got to tell you, as a person who owns some rental properties, I think one of the things that scares me the most is owning a rental home or any home that's vacant, especially in Fresno. Unfortunately, Fresno has some really good things going for it, but one of them is not the fact that we are not, we have a lot of crime going on. And I've seen air conditioners stolen off of roofs in the middle of the night, houses broken into, the appliances.
The fires,
not to even mention the fires, that's right.
With vagrants.
So a lender who is not based in Fresno, and there's not any lenders really based in Fresno, there's one or two, but those lenders don't want to own properties in a town like Fresno. So they would just as soon work with a client, whether it be through a short sale where you stay in the house until the lender's ready to do the transaction. Sometimes a deed in lieu of foreclosure where you stay in the house until the lender tells you to go, and they end up turning around giving you, in one case, $30,000 to not have to go through the foreclosure process. And see, all of those things are available, not to everybody and not to every...
See, and
but only through a housing counseling. See, that's the problem. The average person could do what we do, but with a housing counseling agency like us, because we're approved by HUD, it is a known fact that you're twice as likely to get a loan modification, and the modification will be 1.5 times better than what you could have gotten on your own.
So we're running out of time. I can talk to you for hours and hours about this subject.
That's right.
But the recent report that came out saying Fresno is a healthy market, what did that mean? And is it, I mean, you're on the ground, so if anybody's going to know, it's going to be you and your team. Yeah,
and this was a report that came out by Freddie Mac, and they do these reports on a regular basis. And basically they look at 4 different factors. One is, what's the inventory out there? Are there a fair number of homes available? What's the turn time? How long do these homes stay on the market? Are the prices declining or are they going up in value? And then they look at the period of time it takes to get an escrow closed. And there's probably 3 or 4 other things that they look at. But basically they consider it healthy when it's kind of like if you have a car that isn't running right, kind of like your car. I've seen your car before. And so you take it into the shop and they tune it up, and all of a sudden, man, this thing purrs and hums. It's running like a fine tuned engine, and that's a healthy market. where the buyers are happy, the sellers are happy, the realtors are happy, everybody's happy because it's moving and humming right along. That's a healthy real estate market.
And that's where we are in Fresno?
We are
or
number
would you-
number one in the nation right now.
So, and again, we're running out of time. So in about a minute, first time, we're big advocates of home ownership. We're big advocates of people purchasing homes. But there's a flip side of that coin. Some people don't agree with us.
Yeah.
Your opinion?
Well, I will tell you that not everybody should own a home. But I would tell you also that everybody should try and find out if they're able to buy a home. And if you're able to buy a home, get out there and buy it. This is a great time to buy a home. Fresno's a very affordable market. And if you're not ready to buy a home and you want to look at renting, we're offering classes on how to become a better renter, which means that landlords are going to be more apt to want you to rent that house when they know you've taken the class in how to be a better renter.
Incredible stuff going on at the Housing Council. Talk a little bit about where people can find out more information about you.
The best way is just to give us a call. We're at 221-6919. We have an 800 number. It's 1-885-853-HOME. And either way, give us a call. We are funded by the federal government to do a lot of our programs. We're approved by HUD. We do some really awesome things.
No charge to customers?
We do charge for some of our services, but the foreclosure services, and I'm glad you brought that up, foreclosure services, it is illegal for anybody to charge up front for any type of foreclosure help. So be careful, because we still see people being scammed, paying $4,000 or $5,000.
John Shore, thank you very much for coming on and
Thanks for having
educating
me,
the public again. A lot of new developments in that arena.
Yes, thanks for having me.
That's all for this edition of San Joaquin Spotlight. To the volunteer crew that made this production and every production possible, thank you. We could not do this show without you. They're actually in the studio now as we speak, making this what it is today. Thank you to our audience members listening to the broadcast on 90.7 FM, KFSR Fresno, or the CMAC channel, Comcast 93, AT&T 99. Hope you enjoyed the show with John Shore of the Community Housing Council of Fresno. I'm your host, Sevag Tateosian. Tune in next week for a new edition.